We're already seeing it in many places, but even in the broader based indices, and the Fed will have to adjust, and we'll be on the other side of the horror show we just went in. I think they should put into context what has happened in the last 2 years. Interest rates, the Fed jacked interest rates up 21-fold. Any long duration asset, and in the world of equities, innovation is going to be the longest duration. All long duration assets were slaughtered last year. The bond market, now that's long duration as well, but it's usually a flight to safety vehicle. The bond market last year had its worst year since sometime in the 1700s. If that was going to happen to bonds, which are usually flight to safety, just because they were long duration, that was going to happen to ARK in spades, and it did. Now, where are we? The market is starting to look to the other side of the interest rate increase, and they're starting to look at inflation, which is crumbling. Inflation is crumbling. I know that a lot of people use the word sticky, but you look at the leading indicators of inflation, they are coming down rapidly, and we do believe we're going to see deflation. We're already seeing it in many places, but even in the broader based indices, and the Fed will have to adjust, and we'll be on the other side of the horror show we just went through. I don't think we've been wrong about it. When we were in COVID, we were talking about inventory shortages that would cause supply chain problems and the inflation that would come from that. But I think when history is the judge, and it will be, history will judge the inflation we went through as the result of a massive supply shock to the system. And they will look at the comparison, not to the 70s, which I know Larry Summers and Mohammed El-Arian and others have used that analogy. We were on the gold standard, so money supply had to fall as inflation went up. Inflation went to 24%, June of 1920, dropped to minus 15 in June of 1921, and we moved into the roaring 20s. Why? Massive innovation, telephone, electricity, automobile. This period is much more like that period than like the 70s. And again, history is the judge. It will look at the inflation chart, which went like this and is going like this now. And it will seem like it happened in a flash, even though going through it feels like we're in slow motion. So we started our research on artificial intelligence, actually when we were studying the possibility of autonomous vehicles way back in 2014. NVIDIA at the time was $5. That's on the split basis, $5. Now it's closing in on $450. So we rode it all the way up until mid 300s, mid to high 300s in the flagship. Sold it because we saw the inventory problem brewing. That was a good call. Got back in the fourth quarter when it cratered, and then it just took off after ChatGPT, while all of our other stocks, many of them AI driven, I would say most of them actually, were still very, very weak. And just to give you an example, NVIDIA was at 25 times revenues, while Twilio, which we think is going to be a huge beneficiary of AI, was at 2 times revenue. So we were making a valuation judgment call. We had done very well, 5 to 350 to 400. And we also kept it in our more narrowly focused portfolios, but took profits there as well. I think a lot of people understand that NVIDIA is just an incredible play on AI, and it is priced accordingly. Who are going to be the winners in AI? It is going to be companies with visionary management, good distribution, global in this case, and proprietary data. And we think the secret sauce and the real beneficiaries of AI are going to be those with proprietary data. The biggest one being Tesla. More data on real world driving miles than all the other auto companies and tech companies focused on autonomous in the world.